Hello, my name is Rob Carrig with Carrig Wealth Advisors. Thank you for joining us today. Today is May 20th, 2020. We're going to do something a little different today and use a couple slides as we talk through market volatility and risk tolerance. Let's see. I'm going to share my screen with all of you, and I'm going to start with little disclosures. Leave this up for a second so you can read this, but as always, investing involves risk. There's no guarantees, and past performance does not guarantee future results. As I said, we're going to talk about two things today: market volatility and risk tolerance. So market volatility. This is a slide from the last 10 years of the S&P 500. And there's 10 circles here. The circles all represent times that the market has pulled back 5% or more. And you can see here that there's 10 times that has happened. There are 6 times when the market has pulled back 10% or more, 6 of those 10. And of those 10, 3 times the market pulled back about 20%, 19.8, 19.8 here, sorry, 19.4. And this time from peak to trough, almost 34%. You can see we're most of the way back, and this is just as of April 30th. So the point I'm trying to make here is volatility is not fun, but it's nothing new. What is always new is what causes the volatility. This time, obviously, coronavirus. But at least historically, we have always recovered from these pullback, and I suspect we're going to recover from this one as well. Next slide I'm going to look at here is risk tolerance. Risk tolerance is one of the most critical decisions that an investor can make. And it really comes down to how much of a return do you need to make, and how much volatility or risk can you stomach. So here, what Vanguard did is over 100 years, look at returns from someone on a spectrum of 0 stocks, 100 bonds, all the way to 0 bonds, 100 stocks. So I'll start on the left here. Historically, over the last 100 years or so, if you were 100% in bonds, you got a 5% return. The best single year you ever had was up 32%. The worst single year you ever had was down 8, and on average you got 5. Now, before I go any further, at this point in time, with interest rates as low as they are, my hunch is over the next couple of decades, someone who is 100% in bonds probably needs to expect a return in the 1 to 2% range, which is, probably not even keeping up with inflation. The other end of the spectrum, 100% stocks. That investor averaged 10%, and the best single year they ever had was plus 54. The worst single year they ever had was negative 43. But since there's so many more good years than bad, on average, that investor got a 10% return. Many clients are in this sort of range here, 50-50 stocks and bonds. There you would average 8% historically. But again, you got to be able to stomach some down years, like maybe what we're going through right now. There's some great years out there to average a return, something like this. So that's it for now. I do want to say, as always, let's see, there we go. Here's our contact info. If we can help with anything, our website's listed here, carrigwealth.strewpartners.com. Here's our phone number. To our clients, I know from Jenny, Christina, and I, we say thank you so much. It's been a crazy time period, and thanks for sticking with us through this. For people who are not our clients, if you want a second opinion on what you're doing or what your advisor's doing or the fees you're paying, please reach out. Here's our contact info. To everybody out there, I say thank you, stay safe, and enjoy Memorial Day weekend.